Yo, what's up you guys, welcome back to another video. Today's video we're going to take a look at the interest rate decision, how it's going to impact the dollar index as well as Euro USD, the Nasdaq, and gold included there as well. Without any further ado, we knew that the Feds were going to hike interest rates by 1/4 basis point. We just needed to see it in order to believe it. And now that the information is out, we are going to look at what the next best possibility or probability setup is going to be from a technical standpoint. Now we're first going to look at some articles and understand how we can use that information and apply it onto a technical chart. The first article of the year comes from Sky News. It says US interest rate increased despite worst banking turmoil since 2008. Now if you haven't been living under a rock, you would know that not a lot of banks, but there's been this whole issue with some banks that has filed for bankruptcy. So there's a whole banking problem coming that the markets are currently in, and then on top of that, the Fed also need to stabilize inflation. Now, the way this could hurt the market is that the higher interest rate hike would hurt the market, but the higher interest rate would help inflation. But a lower interest rate would help both basically the consumer and the bank, but it won't help inflation. Won't help inflation. Now the Feds don't know if they should tackle inflation or if they should help the banks. Now it says here the Fed's US Central Bank has increased interest rate for the 9th time in a row. The rate has been increased by 1/4 basis point in an effort to bring down inflation, which in the US stood at 6% over the 12 months to February. It says here a higher increase had been expected prior to the collapse of the SVB Bank, the rescue of regional US banks, and the takeover of Credit Suisse. We also see here that it says at the start of the month before the worst banking turmoil since 2008 began, Fed Jerome Powell had floated the idea of a 1/2 basis point increase, a speeding up interest rates. Last month, the program of rate hikes was slowed when the Fed instituted a 1/4 basis point. So they were initially going to hike interest rates by 1/2 basis point, and unfortunately that was not the case. Now, you know by now, Dow has gone up 200 points. It's obvious because there's a negative correlation between the index and the stock market or indices, like some of you would know. And basically when the dollar's hurt through that, then basically everything else that trades against it, but it's got a negative correlation, tend to move in the opposite direction. Here we got Fed hike rates by 1/4 percentage point increase, that interest rate hikes on here. Now I'm going to explain to you everything that we just read now. Let me just go back over here and see if there is anything that we should be looking out for. Let me just remove this there. So there's a good saying, I think it's sell buy the rumor and sell the facts or something like that. Now what you are currently seeing in the market at the moment, right, is that you're seeing there is a lot of, so we've got the unemployment claims came through at lower today, 191k. And then we obviously had okay, so that's not really news that I look at, sorry about that. And then tomorrow we've got the PMI, Purchasing Managing Index, the flesh, manufacturing, and obviously the services coming through tomorrow. So let me explain to you what's currently happening in the market, and then we'll come to technical analysis. So what you're seeing now is that the investors are now looking at Fed Jerome Powell based off the wording that he used yesterday when he when obviously spoke about the interest rate, is that they're hinting that the Feds are not that likely to go as aggressive with interest rates as they would have wanted to go in the first place. Apart from that, the Fed Powell also said that they are nearing the end of interest rate increases, which ultimately then means it's good news for the stock market because it's good news for consumers, right? Because of that, you get a weaker dollar and you get a stronger demand for the safe haven. But we know that the market moves in waves. It makes an impulse correction and impulse moves. So the market doesn't just fall one time. Like you'll see here, even here, the market fell, the one green candle fell, printed all of this structure, because this is how the market moves, to the downside and basically to the upside as well. Now, it doesn't matter what strategy you trade, doesn't matter what you say, whether you call it an order block, whether you call it a building block, whether you call it a Lego block, whether you call it a cement block, it doesn't really matter. It doesn't matter whether the mitigating and mitigating and mitigating factors needs to be filled with the imbalance and the outbalance and the debalance and the new balance and the mitigating and the, all of this stuff, that, you know what I'm saying. It really doesn't matter. The market moves in waves. That's it. Impulse, correction, and impulse. Whether there's an order block that sits at resistance or at support, that's basically price action that's being taken place. But let's look at the market from a technical perspective. Firstly, we obviously expect a bearish bias on the index due to the market behavior on the interest rates there as well. So we can obviously see that the most recent structure that the market had broken over here is a previous level of support. Once support gets broken, it becomes resistance. So we can also see how the market is currently testing very strong resistance, now acting as support. The market printed a massive impulse, soft and impulse. You expect a correction. The best way to do that is by taking the Fibonacci from the high to the low of this impulse, and we do have a 61.8 lining up perfectly with that structure. I do expect the dollar to just correct itself in the short term, and then from there we can do another update. Next up, we've got the Nasdaq 100. The Nasdaq also trading at a very strong level of resistance over here, as you can see if you look left. So we do obviously expect a correction on the index. So we can see the market never came back to complete this W formation at the neckline. I do expect the index to continue lower, and then from there potentially going higher there as well. Next up, we've got the Dow Jones. The Dow Jones also moved up higher today. However, I'm not 100% convinced over here. But what I would see is if the Dow Jones do want to go higher, I would expect a club break and daily close above this level, and then a continuation higher. Alternatively, I just expect the market to continue lower, to continue this consolidation phase over here. Gold reached an all-time moon to the, gold has gone to the moon. Gold obviously still has clearance to the upside, but like I explained to you now, the market just doesn't move like that. Now, I do expect a pullback here on gold, but gold has got some room to move even further. Now, because gold had already broken above this strong level of resistance, came back to test it as support, I do expect the price of gold to continue higher. The only way we can confirm that we are ready to go long is if we need a clear break above this structure level over here before we can start looking for continuation to the upside, because then the market would break above this level of resistance. That would then be turned support there as well. Alternatively, if we do get a correction on gold, then I do expect the market to pull back slightly down, and then from there continue higher. Next up, we've got Euro USD. Euro USD also got clearance to the upside, but it is unfortunate that the market needs to pull back now. We have that impulse, soft and impulse. You expect a correction. Taking the Fibonacci from the low to the high, we do have a 50% pullback. The market had also testing very strong structural level, acted as resistance, broke above that, support, resistance, rallied lower, come back to test it as resistance once again. I do expect Euro USD to continue lower, and then from there possibly continuing higher once again. Now, that is all from my side, guys. I want to say thank you so much for your time, and as always, cheers, fair years.